Are you tired of getting stressed when your investments start losing value? Do those highly speculative stocks you try buying just not go to the moon no matter how many rocket emojis you use? Well, you've come to the right place because today we're going to be discussing human psychology and the stock market. Specifically, some very common human biases that everyone experiences as they're investing and what you can do about them. So, before I get into the crux of this video, I just want to state the obvious here. I'm not a scientist, guys. I don't have a degree in neurology. But that doesn't mean I can't have a discussion about the various biases that impact how we make decisions that influence our money. And to be honest, I find it very striking how certain people can learn extensively about these psychological factors and yet still ignore them and make irrational decisions. Even the very people who've won literally Nobel Prizes for studying finance theories still fail to even follow their own advice and will make irrational decisions. So I hope you guys find this stuff as interesting as I do, and with that in mind, we'll get right into it. So the first one is the sunk cost fallacy. And I'm starting with this one because it's definitely one that beginner investors out there who just haven't had the mental reps of investing and truly putting your money in the hands of the free market are very susceptible to. So a quick economics lesson for those who aren't aware of what a sunk cost is. It's an economic term that just refers to costs that you've already paid in the past and cannot get back. And the important thing about sunk costs is to know that they shouldn't be considered in future decision making. So for example, let's say that you have a village of people and they're trying to build a bridge over a river. So they build that bridge. Let's say it costs them $1,000 to build that bridge. And as soon as they finish building that bridge, it breaks down and it collapses. Then the mayor of that village says, well, we've already spent $1,000 on this bridge. Might as well see it through to completion and rebuild it. Now, this is a prime example of the sunk cost fallacy because the $1,000 had already been paid before the mayor made the decision to rebuild the bridge, when in reality, it's a sunk cost and should not be considered. And this applies to investing. When your investment starts to lose value, and then you go and sell it because it lost value, and you just wanted to get out before it got really bad, or maybe you just got a little scared. It happens sometimes. So how can you avoid this? My advice is to make sure you always have a plan before you invest, specifically a time horizon that you plan on investing for, and make sure you stick with it. If you invest in something and then the very next day it drops 20, 30, 50% in value, and then you get scared and feel the need to maybe sell, you must ask yourself, is there any fundamental reason why I should sell this? Or is it all out of fear? Now, if you invest in a company and they suddenly announce they went bankrupt, then yes, you should seriously consider selling because that's an example of a fundamental reason. But if your investment just dropped a little bit, because that's what they do in the short term, they move around all over the place, then just relax. Don't worry about selling. If you remember my last video, I really stressed the importance of holding on to your investments for as long as you can because research and historical data show that the investors that hold for as long as possible, and I'm not just talking about 2 to 3 years, guys, I'm talking about 20, 30, 40, 50 plus years in some cases. I mean, if you ever want to know why Warren Buffett is so rich, he bought his first stock when he was a child and now he's 90 years old. So it does make sense. Another way you can avoid this is to stop looking at your investments all the time. And I know saying this is really asking a lot out of a beginner investor to not constantly monitor their investments, especially with the advent of zero commission stock trading platforms like Robinhood and Wealthsimple. They make it very easy to do this because someone who is new to investing really won't have the self-discipline to not constantly monitor their investments. I know I did this a lot when I started out. It's pretty normal because after all, it is your money and obviously you care about it. And it does take some getting used to before you can learn to not check your investments all the time. Okay, so the next one we'll talk about is the bandwagon fallacy. Now this one is extremely, extremely dangerous, guys. And we really saw this take full effect in the whole GameStop saga. So basically what it is, it's the tendency for people to do things only because other people are doing them. And you can call it various other things such as herd behavior or FOMO. But we all know it's definitely something we've all experienced at some point. And it's really amazing how irrationally it can make us think. Like, why would people be investing in GameStop at $400 a share when you literally could have bought it a couple days prior to that for $40 a share. It's because people think that whatever is happening now will continue to happen into the future, guys. But make no mistake about it, this bandwagon fallacy we have really stems from our survival instincts. Humans have always been stronger in groups and have gravitated towards group thinking rather than being the outliers, because previously in prehistoric times, being the outlier was how you got eaten by a bear. It's the same thing with pattern recognition. We think that whatever is happening now will continue to happen into the future, and even though our rational side will tell us, well, that makes no sense, it's this type of pattern recognition our brains are designed for that has allowed us to survive for thousands of years. And that's a common theme when it comes to human psychology and the stock market. It's the way our brains have developed through thousands of years of evolution that really just makes us suck at investing. So how can you avoid the bandwagon fallacy? Well, one thing you should keep in mind is that following the herd is not a great investment strategy. As I've said before, if you take a buy and hold long-term approach, focus on long-term financial goals, whatever is happening in the short term won't matter, guys. Do not make decisions that influence your long-term financial goals based on information that's only relevant in the short term, which is what chasing trends usually is. Okay, so last one I'm going to talk about is the hindsight bias. And the hindsight bias doesn't have as much to do with making poor decisions as events are unfolding, but more about how we view our previous decision making after the events have played out. And what it is, it's how humans have a tendency to convince themselves that they had seen an event coming all along after that event had already occurred. So something that is very common after a financial bubble pops or after a financial fraud like a Ponzi scheme gets busted, when people learn about those, they think to themselves, well, how could anyone have lost money in that? Obviously didn't know what they were doing, and that sort of thing would never happen to me. But it's not always that simple, guys. In fact, there are typically a lot of very smart people that fall victim to Ponzi schemes. And why this is dangerous is because we can get too confident in our ability to predict future trends, and we might feel like some investment idea we have is very likely to succeed, when in reality it's all just based on a hunch rather than actual fundamentals. So how can you avoid this? Well, I think it can be avoided pretty easily if we're talking about individual stocks. You just got to ask yourself, have I made any attempts to value this company using any sort of valuation technique? Or have I calculated their financial ratios and compared those to their competition? Or have I looked at the management team to see how experienced they are? If the answers to those questions are all no, then you might want to rethink things and take the time to do all that stuff. And if your reason for not doing that stuff is you don't want to wait before buying the investment because it could go up in the meantime, then again, you should rethink things. Because if it's a good investment now, then it'll still be a good investment in a few days or a few weeks or whenever you get around to actually investing, barring any drastic unforeseen changes. So those are 3 big behavioral finance concepts, and keep in mind, guys, there are literally hundreds of biases and fallacies that exist out there. So I'll throw up a list here in case you're interested in learning about some more. But with that in mind, like the video if you enjoyed it, and please consider subscribing if you're new and you like this type of content. And with that in mind, till next time.